Thanks for joining the call today. Basically, we're going to be talking about something that I'm really passionate about. Basically, I started investing in real estate back in 2020. Since then, I bought 5 properties. Throughout that process, between these or amongst these 5 properties, Ashish and I have basically saved around $200,000, I think, in federal income taxes up until this point. I haven't calculated the 2024, so it might be a little bit more, it might be a little bit less, but somewhere in that ballpark. It's a big deal because it allows me to buy more real estate. And basically, I'm buying real estate using tax savings, right? So like the $200,000 that I saved, I'm able to reinvest, and we bought another duplex using that tax savings. And so even that new duplex is saving me more taxes. So it's this compounding strategy that's super powerful. And basically the main point is understanding taxes, especially real estate taxes, which is so exciting, so that you can scale your portfolio faster, so that you can buy more assets. Because again, the name of the game is buy more assets. That's how you grow your wealth in real estate. Other than that, just been posting on social media about this journey. A lot of high earners like the idea of saving taxes. A lot of people are looking at their W-2, they're looking at that $100,000 tax bill. They never ask the question of how do I reduce that number down to zero? Or it doesn't have to be zero, that's a very aggressive approach, but maybe down to 50 or down to 30, right? So it's a very important thing to understand. So glad to be here and get into it a little bit.
Hey, that's perfect. This is Ashish. I think all of us here have a passion for real estate. As a firm, we do accounting, taxes, tax planning for real estate investors. And when I talk about real estate investors, I want everyone to understand this. We're not just talking about someone who goes and does real estate full time. We have doctors, engineers, CEOs, CFOs from full-time jobs, and they want to save taxes with real estate while building their long-term wealth. You could own any business, and you'll see most of the wealthy business owners will eventually invest in real estate for the things we're going to talk about today. So I can almost guarantee you, if you have a good financial plan in place, you will invest in real estate one point in your life. And then calls like this, who try to give free information to people, is really helpful because very less people talk about this in a more professional setting. You can go and read about it, but half of things are wrong and they don't show you the numbers. We will today. Let's say if someone like Mike saves 200,000 in taxes. Remember that $200,000 you get from IRS back is net of tax, meaning you don't have to pay tax, not an income. So if you had to go out and earn $200,000 from W-2, that's a $317,000 for someone in 37% tax bracket, ignoring state. So you actually have to go make another $300,000, a full-time job, maybe another an IT job you have to go and work to save that $200,000 to invest in real estate, which you're getting from just by investing in real estate without actually having to go work for it by investing. So that's very powerful. Remember, even 50, 30, $20,000 is a huge amount of money of tax savings. We don't have to go to $200,000. You could, and we will give you some threshold. And other thing is real estate. Why we are just talking about real estate? Is there any other tax savings other than real estate? We'll talk about why real estate as well in the next few minutes versus why other strategies. And we'll give you other strategies as well once you invest in real estate. So we'll get this started with that background. Kinsley, stop us and ask questions. And if things are getting too complicated, you can interrupt us and ask some simple questions that we have in chat, and then we can answer them and move on.
Yeah. Quick personal intro or question for you, Mike. What made you want to start real estate investing?
So I started in 2020. This was when interest rates are at 2%. Before then, I had done something called Airbnb arbitrage, where you don't buy the property, but you lease an apartment from like a landlord. Instead of living there, you turn it around and you furnish it and you rent it out to other people. Basically, you're subleasing. It was a good intro into managing a property, but I knew I wanted to own my own property eventually. So the very first property we bought was a $220,000 property down in Joshua Tree, California, 2% interest rate. My mortgage was like 800 bucks. So I was like, worst case scenario, if this thing doesn't rent out, I'm making 200K from my job. I could pay for this thing even if there's no tenant. So the risk was relatively low, but the upside was very high. We rented it out on Airbnb, ended up profiting like $20,000 after all expenses that year. So really good investment for us, considering we only put $40,000 down. So you're looking at 50 plus ROI right there. But the big kicker is that home appreciated by $300,000, which is absolutely insane. Once in a lifetime, basically chance of luck because COVID. But we basically rolled that property using a 1031 exchange. We took the entire equity of that property, which was around $340,000, and we bought a $1 million property in the Bay Area. And around this time is when I got promoted at my job at Amazon where I work. And I got that W-2 bill that says you're paying $100,000 in taxes. I was like, how am I going to reduce this? And that was
Wow.
the year that I found Ashish. I found him through the Bigger Pockets forum, actually. I don't know if you know this, Ashish, but you were posting some really good content on Bigger Pockets forums, and I was active on the forums. You were answering these questions, and I was like, all right, and then to go talk to him. I just found out that this property that I had just bought that year using that 1031 exchange, I could claim bonus depreciation on it. And that property we ended up buying using the equity from the first home ended up saving us like $40,000 or $50,000 in taxes, which is insane to think about considering that first property we bought for $40,000. We exchanged it for a $1 million home in the Bay Area. And then that $1 million home saved us $40,000 in tax savings. So if you think about what that means, it means that we are essentially owning a $1 million home in the Bay Area for $0 out of our own pocket. And then after I heard about that, I was hooked. And we've been doing it for the past 4 years ever since. Every single year, we buy X amount of real estate. It helps me and my wife pay the significant amount less in federal income taxes. And that's just like this simple cycle. Every single year, you just buy enough real estate to knock yourself down in terms of tax bracket. So you're paying less taxes. And you just do that over a 20, 30-year span and you'll be good to go. That's where I'm at right now. I would say it's a boring strategy, pretty much. We're just repeating the same strategy over and over again. I wouldn't say taxes are very complicated, but once you have a strategy in place, you just follow the same blueprint and you should be good over a 10-year span. So hopefully we're going to talk about that today.
Yeah. Wow. My next question, I don't even know if you had any challenges, but were there any challenges or mistakes that you have learned from that you wouldn't make in your next?
Yeah. So I think part of tax strategy, right? I always say tax strategy is like a chess game because there's so many questions about what type of property do you buy or how much real estate should you buy? Because I will say in our very first year of us doing this, we got a little carried away and we were like, we want to pay zero tax. So we bought way too much real estate. It actually wasn't strategic because we didn't actually have enough money next year to buy more real estate. We blew all our cash in 1 year. Although we did get a very fat tax savings, it wasn't enough for us to go buy the same amount of real estate next year. But the problem was that next year was actually a bigger income year for us. So we needed to buy more real estate that year. So what we should have done is we should have bought less real estate in the first year and reserve some cash to buy more real estate the next year. So things like this are what we talk about during tax strategy. Well, how much real estate should you buy in a year? What type of real estate should you buy in a year? If you buy X amount of real estate, how much am I going to save in taxes? So a lot of it is just planning out, not just this year, but 3-4 years out the road. So one of the biggest mistakes we made was only thinking about this year and not thinking about next year or the year after that. That's why tax strategy is so important. And that's actually the number one reason why I wanted to work with you guys, because the past 4 CPAs I worked with, none of them offered tax strategy. They only do your tax filing, which is a separate service. And so I always tell people on my social media, tax strategy is actually more important than tax filing, because anyone can do tax filing, right? You don't need to technically pay, but tax strategy is actually the more important thing that's going to save you the most amount of money in taxes. So that's what I learned.
Speaking of tax strategy, so you mentioned 1031 exchange and bonus depreciation. How has your tax strategy evolved working with us?
So I think basically there's a concept called real estate professional status, which I'm sure we'll talk about today. But between real estate professional status, this concept and bonus depreciation, those are like the 1-2 combo. That's pretty much how me and my wife have been saving a good amount of federal income tax every year off our W-2 jobs. I think those are the key pieces of our strategy, at least. And like I said, we've just been implementing the same strategy for the past 4 or 5 years. I wouldn't say anything's really changed, but I think what we have done kind of tweaked is we've become much more focused on buying a certain amount of real estate every year. So like in January, when we do the tax strategy planning with Ashish, he'll go over and say, hey, you guys are expected to make about 500K. You guys should plan to buy X amount of real estate, and that will bring your income down to like maybe 250. Maybe you want to go less than 50, which means you're going to have to be a little bit more aggressive, maybe buy more real estate. But generally speaking, that's how we think about it. It's like at the beginning of the year, we say, how much are we going to make estimated? And if we want to report an X income, right, then question is how much real estate do we need to buy? And do we have enough cash to buy that amount of real estate? And so those are all the questions that we talk about during tax strategy. But I would say the strategy itself has not really changed. It's more just those 3 kind of questions.
Gotcha. And Assis, do you want to touch on any of those strategies that he mentioned?
Yeah, just to comment on some of the points Mike made earlier. Mike, you're talking about I know this is a boring strategy and it's slow. I have so many young clients. I would call them lucky clients because when their parents did this boring strategy when they're younger and they inherited these properties, they don't have to struggle like we do. We had no inherited money from our parents. They're already up here. They're making big decisions. They're creating businesses, softwares. This is gonna rewrite your legacy. People don't understand this. Younger clients are hustling like us. We're making money and buying real estate. It looks boring and stuff, and we do best we could. But some of the clients that I've worked with who are young, their parents did what we did. Their life is up here. So this is gonna pay off in a huge way because remember, you're so smart, and then everything you're building, you're just gonna throw it away, right? You're gonna do 1031 exchanges. New laws gonna come, and some of the good property is gonna get inherited by your kids. And if your kids can start with $1 million property paid off, their life is done. To be honest with you, very powerful, which we do not understand it yet. I'll say that. Second thing is what you're talking about. You bought this $1 million property with no money down, right? Remember, even if this property makes $3, $10, if you strictly talk about ROI, is infinite return, right? So you have no money down, there's no investment, and anything you make is infinite. People are striving for 8%, 10% return in the market. You're getting infinite return in this property. Insane. I know you're not gonna make $100. People make bunch of money with $1 million property, and especially when they sell them. So in the numbers game, it makes so much sense. And the last thing I want people to understand this, and we'll talk about why real estate maybe in the next few minutes, but diversification, guys. In my own scenario, I had invested in the properties in multiple areas, even with the same state or different state. One state might go 3 times the value. Other might stay the same. It will never go down. Remember, the power of real estate is in the long run, it's always forgiving. You can make $10,000 mistake in one property, it will be wiped out in 3 or 4 years. It will always go up. So what I'm saying is the other property might triple in value. No other strategy businesses will do that in a safe manner. You can go and invest in crypto, or you can go invest in stock. They're always going to have a bigger risk, but you can achieve the same thing without a huge risk. So I'm not saying invest in one thing or another, diversify between various markets, and you'll do great. So all that being said, I know we have a bunch of questions. We're gonna answer that later on, but I wanna touch upon some of the numbers and run some numbers for you guys. I'm gonna talk about why real estate versus other businesses first, and then actually run one very simple scenario of what Mike is saying, what he did, and what you should think about with real estate, and then we're going to answer those questions because they're pretty good questions as well. Let me answer why real estate, why wealthy people invest in real estate, and why it makes sense. I'll give a very simple example. Let's say you have a business. Because basically what real estate is doing right now is just creating a lot, like paper loss for you and offsetting your W-2 income or business income and saving you taxes. Very simple, and we'll learn the numbers for that. But let's say rather than real estate, you go invest in another business. I don't know what it is, but any kind of business, okay? And you buy a printer for that business, which is also expense. It creates a loss. You can write that loss against your income and save taxes. That's why a lot of CPAs who do not understand strategies will say, hey, go buy more stuff, go buy a vehicle, go buy laptops for your business, make all the expenses in your business and save taxes. Yes, that makes sense, but how is it different than real estate? In this business, let's say a printer costs you $100,000, they're expensive printers. By the end of 5 years, you cannot go sell this printer for more money. You got to write off $100,000 in your taxes to save, let's say, $30,000, but you lost that $100,000. In real estate, it's exactly opposite. You buy this $100,000 real estate, let's say you save $30,000, and then when you sell real estate, you make more money by selling real estate. This doesn't go down to zero. Unlike printer, it goes down to zero, you still retain the $100,000. It might have been $300,000 now. That's why you save taxes, plus you also make more money. There's no actual depreciation. And there's a concept of depreciation recapture and how to manage that. One of the questions was that. We can talk about that. But there's a 1031 exchanges. There's a lot of things we can talk about to mitigate that. And we'll talk more on that front. This is why rich people invest in real estate. I'm not saying they don't invest in other businesses, because businesses give them cash flow and they take all that money and put in real estate.
Can I say one thing? To simplify what you just said, real estate is the only asset that you'll find that depreciates, that gives you tax benefits, but also appreciates at the same time.
Exactly.
It's a depreciating, appreciating asset. It's the only one, right? And I will say more than half of my net worth comes from real estate appreciation. So the idea that you build wealth through cash flow, that's just not true in real estate, right? People in the Bay Area, you guys understand this, right? Think about if any of you guys bought a home anywhere in the Bay Area 5 years ago, it would easily be over $300,000 more than it is 5 years ago, right? And the great part about that is there's so many strategies to not pay taxes on that $300,000 gain, right? The example I was sharing earlier, right? Not only did that $1 million property that I bought save me $50,000 in taxes, but it has also appreciated by $200,000 in the past 3 years. I'm getting a $50,000 tax benefit, and then on top of that, it's appreciating by $200,000, and I will never pay taxes on that $200,000 gain either because of the 1031 exchange, right? Maybe later down the road, because most of these strategies are usually deferment strategies, but if you understand both sides, like the front end of the business is like the cash flow, the appreciation, but the back end of the business is the depreciation, the tax benefits. That is such a big part of the business as well. And people understand the front end. Everybody understands cash flow. My monthly payment is $3,000. I rent it for $5,000, $2,000 cash flow. That's actually like the least important thing about real estate investing, at least for somebody who's a high income earner, because if you just cash flow, you're just going to pay taxes on that. So you're really fighting an uphill battle. The real money is made in appreciation because appreciation can be grown tax-free and it can be leveraged tax-free. So yeah, super crazy. I could talk about it all day.
And the uphill battle that Mike was referring to is you go into the business to make money. And real estate, you make money but don't get taxed. Other businesses, you make money, you get taxed. Real estate, you can manage that. This calls portfolio optimization. We can talk about this maybe on the next one. How portfolio optimization works for you guys. We're going to talk about this short-term rental today. Unless you buy this, first year you're going to save $200,000, let's say. But next year, short-term rentals inherently makes more money than long-term rentals. You're going to start making cash flow. Now, if long-term rental never saved you taxes because you never could qualify as reps because of your W-2 status, they can optimize each other and save taxes, and you still pay zero taxes, even with long-term rentals now. Remember, all this hype about short-term rental loophole is because as a real estate investor, if you're a W-2 employee like Mike, you go invest in this commercial property, strip mall, or this apartment building, your tax savings is limited. That's why you go to short-term rental. But what I am talking about is complicated. I'm not going to lie. Once you buy a short-term rental, save this big tax savings, which I'm going to show you next minute. Then now you can buy long-term rentals. You can invest in other people's fund, or you can invest in apartment buildings. And then those investment, which could never save you taxes immediately, now you can offset your short-term rental income and make them both passive. Not the conversation for this call. Let's walk you through some numbers so actually how the tax savings happens. And then if the time permits, we have some people asking how this works. They're curious. So I'm going to share my
Let's show the
screen.
numbers.
Yeah. I'm going to share my screen. I'm going to run the numbers because I can talk all day about it. You can see it is complicated. And then me actually showing you the numbers is going to help you. Ignore all this detail, okay? It's our tax planning module. Just focus on a few numbers I'm going to show you. And we are converting this to a software. So next year, you guys can do this on your own on web-based tax planning software. But very simply, let's say Mike lives in Colorado. I'm just making the easiest state. And then he's married and he makes $600,000 from his W-2. You make $600,000.
I'll make 600, just an example.
Yeah. Mike, you'll get there eventually, very soon. Let's say you make $600,000 and your AGI is 591 after an SSA and 401ks. But again, your W-2 is $600,000. It could also come from a business, by the way, but imagine W-2. You have no other businesses, you have no other tax savings like you could do from business. You started with this base. How does this real estate work? I want to show you, and it's going to look complicated, but just focus on a few things. Your taxable income is going to be this because of your $600,000, you have standard deduction and everything. I just want to show you something. Let's say 100% bonus depreciation comes back based on the promises we have from our administration. And then you do cost segregation, which is driving all this tax savings at 25%. Just focus on this number, line 32. I'm hovering here. Right now,
First, can you show them how much taxes they would be paying without real estate?
This is $161,000. So tax savings without real estate right now, you're paying $161,000 federal and state right here.
That's a lot of money.
If you wanted to pay zero taxes first, and then we can go down to the other numbers, but if you wanted to pay zero taxes, if 100% bonus depreciation comes back for this year, you have another 8 months to plan for this. And you can do this in December, it's still the same amount. There's no proration. You go and buy this at 2.257,600. You go and buy this, your upper threshold, short-term rental, 2 properties, let's say in Bay Area, you're paying zero taxes. You're literally paying zero taxes. Meaning I want you to look at this before and after real estate. I want to show you something here. With and without real estate, again, it's a lot of numbers. You just focus on this. With real estate, without real estate tax savings, and with real estate tax savings, you're paying zero taxes here. You're $164,000, like we showed earlier. Now you're paying only $3,000. This is a Medicare tax that you cannot avoid. Basically, you're saving $161,000 on taxes. That's what I was showing you in another tab, and I know this looks complicated. To simplify this, all you need to understand is without real estate, you're paying $161,000. Now with real estate, if you maximize your threshold, you're saving $161,000 on taxes. That's the very simplistic way to show you the numbers.
That's like the most aggressive thing you could do.
Yeah.
That's what he's mentioning here. That's why it's called upper threshold. But I will say it's not the most strategic. Always. It might not be the most strategic thing to go buy $2.2 million. That's just if you want to pay zero taxes. But you guys have to understand that because of the way that the tax brackets work, basically what would be happening is you're lowering your taxable income, right, by buying these properties. So if you started at 600, you're in like the maybe 35% tax bracket or maybe 37% tax bracket. So if you went and bought, let's say, $1 million property and reduced your taxable income by like $300,000, you wouldn't be reporting a $600,000 income anymore. You'd be reporting a $300,000 income. Now, you could go buy another $1 million property, but you have to understand that you're no longer in the 35% tax bracket. You've dropped from the 35% tax bracket down to the 24% tax bracket. So from 600 to 300, you are lowering your taxable income while you are in a high tax bracket, which means every dollar that you reduce your taxable income by, you're saving like 35 or 32% taxes, right? Because that's the tax bracket that you're in. You're dropping from 600 down to 300. That's all in the 32, 35% tax bracket. But it becomes less effective when you're like in the 300, when you're going from 300 down to zero, because if you understand the tax brackets, you're in the 24% tax bracket when you're at 300K, assuming you're married, right? And if you drop your income from 300 down to zero, like you're only reducing your taxable income while you're in the low tax brackets. So you would only be saving like maybe 15% on average for every dollar you reduce your taxable income by, going from 300 down to zero. So there's a diminishing return to this strategy. There is much more returns when you are dropping your taxable income from a very high tax bracket to a medium tax bracket, because you're like all of that money or all of the income is in like the 32% tax bracket. So what I've been doing is with my wife, we don't reduce our taxable income down to zero every year. That's a very aggressive thing you could do, but we pretty much just reduce our taxable income enough to get us out of the high federal income tax brackets. So we aim for the 22% or the 24% tax brackets. But anytime we make like a big year where we're in like 37% tax brackets, like last year, we go out and buy enough real estate to lower our taxable income so we come back down to that 22 or 24% tax bracket, because we're okay with paying 22%. 35 is quite a bit, right? So we usually just buy enough real estate to get us out of the high tax brackets. But again, Ashish is saying here, if you want to pay zero taxes, the most aggressive thing you could do is go buy $2.2 million worth of real estate. And it would save you $160,000 in taxes.
Yeah, I completely agree with what Mike is saying. Remember, if you have $10 million sitting in a bank account, you can fund the highest threshold every single year. Go ahead and buy the highest threshold. But think about long term, like next 5 years. Your WT is going to go up next few years. Have the ISOs and RSUs coming in, which in the valley it happens a lot. Then you have to be strategic of your cash reserves. This year I'm going to take it from 37 to 10% or 15% tax bracket. Next year I'm going to do the same thing. You're going to end up saving more money by wiping out highest tax bracket in the next 5 years versus trying to wipe out 10% tax bracket this year. That's where you need to work with the CPA, okay? But just to show you the numbers, $2.2 million, wiping out entire thing, you're saving $161,000. If you were to drop this down, let's say you go buy $1 million property, you're still saving half of the 161. You see, almost saving $90,000. So you saved, by lowering your threshold, you're saving $86,000.
But here's the thing, right? The crazy part is, someone asked in the comments whether you need to buy it in cash or you can finance it. The crazy part is that it doesn't matter how you buy the $1 million property. If, for example, you were somehow able to put 10% down, that means you would only spend $100,000 of cash to buy a $1 million property, but you would get the exact same tax benefit as if you had put 20% down. So if you put 10% down, according to this form right here, you put 10% down, you spend $100K, you would save $86,000 in tax savings. So you would really be in the deal for $14,000. That's the crazy part, right? And if that $1 million property cash flows like $2,000 a month, What's your return on investment if your investment is $14,000 and it cash flows $2,000 a month? And then on top of that, this home is going to appreciate over time. That's the power that we're talking about. That's the difference that understanding taxes makes in this deal. Because otherwise, you're calculating your return on investment with your full $100,000. And if you're calculating on a $100,000 investment, your return on investment is going to be pretty bad. But if you're calculating your return on investment as if you only invested $14,000, that's a pretty damn good deal. And that's what allows me to recycle my money. Because every time I'm buying these $1 million properties, I'm getting an $86,000 tax-free rebate effectively. And I can use that money to go buy more real estate. Now, obviously, there's some talk about depreciation recapture, which means that this tax savings isn't free. If I ever ended up selling this property, I would have to pay a good amount of this $86,000 back. And so that's where the long-term strategy needs to be. You need to think about that as well. So it's not a tax-free strategy by any means, right?
Yeah.
We're not trying to sell some crazy strategy here.
And if you understand this, what happens is, remember, real estate is very, especially when the market is good, 100% bonus depreciation comes back, market is competitive. If you know your ROI, you can outbid other, you can pay $5,000 extra on the property and you would get the property and save $86,000, right? You might lose the property if you don't understand this. What Mike was saying is, look at this. Down payment is only 10%. I already saw that to my clients. You put this down payment 10% on this property as a second house. You save $86,000. Your net investment is $13,000. If property makes $2,000 a year, which short-term rental does, it's 100% return, first of all. Second of all, when I said 10% down payment, if you can negotiate seller financing with no money down, you can buy a property anyway. Bank is funding 90% of that. So just to talk about this strategy, just wrap up into the numbers. All I'm saying is $100 million is going to save 86. Let's say $700,000 in the Georgia mountain will save you 65. Even $500,000 property is going to save you 50 grand. Still a good amount of tax savings. Your net investment is only $3,000 to buy this $500,000 property. You can get that from 1 year's month of cash flow from short-term rental. Again, your CPA can run this number for you. You don't have to get all these numbers from right now because we do not know your situation. I know we're talking about $600,000 individual. What happens if someone is doing only $200,000? I'm just going to walk you through the $200,000 scenario here. Let's say you're making $200,000 a year. What happens with $200,000 taxpayer? Right now, with state and federal, if you live in Colorado, you're in 26% tax bracket, almost 27% tax bracket. So when I go to real estate strategy here, your highest threshold now to wipe out your entire taxes, which is around $33,000. Still a good amount. $33,000. You can go buy a new car with that, and if you save entire amount. Your threshold is only $657,000. So you go buy one property worth $600,000, you're saving entire $33,000 in taxes with 100% bonus depreciation, which might come back, right? But let's say you only buy $300,000 property because your earnings less, still save 20 grand in taxes. It doesn't matter which bracket you fall. It's about a relative tax savings in your tax bracket. It's going to be significant. So it doesn't have to be $1 million property. Okay, it can be $200,000 property, $300,000 property. That's how this works. So I'm going to stop my share. I know there's a lot of numbers there. And then we're going to take a break with some questions here, because if we keep on talking about this strategy without answering questions, people are going to get distracted and don't understand this. I'm going to read some questions from the top and just answer them. And then if you have to add anything, please do. We have multiple questions. Does bonus depreciation apply to state taxes as well? Some state allow, some state do not allow bonus depreciation.
California doesn't.
Yeah, California does not. And then Colorado does. Just so you know, remember, bonus depreciation is a good stuff, but you don't have to have a bonus depreciation, meaning we're not just relying on bonus depreciation. Let me show you the numbers here. I want to show you this really quick because this impacts what you're talking about. It doesn't really matter though. If you live in an MA and if you make $200,000, I want to show you the numbers. It's all a numbers game, right? You go buy a real estate, $300,000 saved $19,000 earlier. Now it's saving $16,000. State taxes are always less, so it doesn't really impact that much. We still save some taxes, $500, not entire taxes, which is $7,000. I'm not going to complicate this with numbers, but some states allow, some states do not allow, and we can walk you through the numbers. The other question is, what are the limitations for cost segregation study? For example, I have a rental property, but I don't have real estate professional status and not materially participating, then would I still able to do this? Yes, remember what we're talking about right now is short-term rental. So there's two ways to save taxes from real estate. Long-term rental and short-term rental. Long-term rentals are everything else that's not a short-term rental. Strip mall, your apartment building, everything is considered long-term rentals. You have to be a real estate professional that rep status to save taxes with long-term rentals. But this we're talking about is still real estate. Rather than buying a $300,000 long-term rental, you're buying a short-term rental, and then saving you taxes. This is what I was talking about earlier. Once you have a short-term rental, then you can buy this long-term rental to have that synergistic relationship and save taxes. But rep status is needed for long-term rentals. Short-term rentals loophole is easy to meet with the material participation, and that's a whole different conversation.
Yeah. I think one thing I wanted to call out with this cost seg question is you don't need to be a real estate professional to claim cost seg or do cost seg or claim the bonus depreciation. What a real estate professional status does, once you claim bonus depreciation, what's going to happen is on your tax return, you're going to say for that one rental property, let's say it may have $50,000 of rental income, you're going to have $300,000 of expenses. Like 250 of that 300 is probably going to be the bonus depreciation. Obviously, bonus depreciation is going to be that first year like elephant of a deduction. So imagine having $50,000 of rental income and then $300,000 of deductions, mostly from bonus depreciation. You're going to have a $250,000 loss. That's going to be considered a passive loss, and passive losses can't be used against W-2 income because W-2 income is considered active income. So big thing to understand is that passive and active don't mix. I always say that's like oil and water. Passive and active, they just don't mix. But having real estate professional status allows you to mix oil and water. Since is essentially the kind of thing I like to say. If you don't have real estate professional status, it's okay to have the losses as passive, but you're just not going to be able to use them against W-2 income. But what you could do is you could go buy a short-term rental. And if that short-term rental performs very well, you could potentially have a very large net income from that property. So let's say the property profits $40,000 after all expenses that year. That's going to be a $40,000 passive income. You have $40,000 of passive income from one property, and you have $200,000 of passive losses from another property. You can use passive losses to offset other forms of passive income. So you could basically negate your Airbnb income by bonus depreciating one other rental property. So you can play everything on the passive side. You don't always need to negate your W-2 income. You can negate other forms of income like your Airbnb income using those passive losses. So you don't always need real estate professional status. You only really need it if you want to use losses from real estate to offset W-2 income or business income from your like 1099 or something like that. So there's other strategies on how you can use those losses. You don't always need real estate professional status is the point.
Can I add one more thing on that one? This is where the rich people save taxes. I'm not very political, but I want to give an example of Trump here. He's a big real estate investor. He's not trying to go behind the rep status. He's not trying to buy short-term rental and save taxes. You know what he does? What he does is he has these businesses and stuff which is already passive. He doesn't go and work. He has CEOs and CFOs that are working in the business. Everything he does is passive. Now he invests in real estate passively, in the apartment building, even short-term rental without being materially participating. Normal people like Mike and I who get started and who doesn't have a generational wealth, at least from my inner situation, what people do when you get started is they will try to make everything non-passive, meaning they buy short-term rental, they want to be rep status, they make non-passive so they can offset their non-passive of the income, which is your W-2, your business income. As you get wealthy, what people do is they try to convert everything to passive, meaning even your business, you want to be less involved, you want to go on a vacation and have someone else run your business, make it passive, what Trump does, and then go invest in real estate passively. That's where you need a long-term strategy. We're talking about 20-year strategy. When you get started, when you're building your wealth, what Mike is doing right now, you become actively involved, materially participating in activity, getting rep status to save $1 million in the next 10 years. And then once you have wealth built out, then you become passive in your business. So you don't have to chase rep status. You don't want to do property management. You just want to invest like what the rich people do, save taxes. Whole different conversation, but I wanted to tie that in from tax point, what Mike was saying earlier. We have so many questions. I'm just going to go through this list again.
I'm trying to type in the answers here as I'm going because some people are posting in the chat. But if you have questions, put them in the Q&A. It's easier for me to answer.
So next Q&A is rep status difficult to obtain. How can we get this status with W-2 income? Yes. It's a short-term rental loophole, not just Airbnb, it's a STR loophole.
Yeah, it's basically rep status or short-term rental loophole. Typically, the people who do have reps, like 95% of the time, it's always going to be like a married couple, where one person is the high W-2 income earner and then the other person is the rep. Because if you're married filing jointly, you can use the rep status from one spouse on your combined tax return. So that's what me and my wife do. My wife is the full-time real estate agent. Rep status doesn't mean you're equal to real estate agent. You can be in construction, basically anything that really touches real estate on a day-to-day basis, like property manager, construction, any of those type of jobs, or you can claim real estate professional status. So basically, if you're a software engineer, go marry a rep and you guys will pay less taxes. So that's like the inside joke between all me and my software engineering friends is we're all looking for real estate professional wives.
I say that a lot. Someone single comes to me and talks about tax saving and they talk
Need
about
a-
I have W2, I cannot be reps. When you're networking on your apps, please put that condition that you have to be a
Yes.
real estate agent.
Yes. That's a good way to
Yeah.
do it. It doesn't mean that they make less money. They could potentially make more money being a real estate agent than you guys, right? Every real estate agent should know about this. Like most real estate agents don't even know this, that they have this special status.
Mike, in a normal example earlier, think about this. You make $600,000 and then your spouse does nothing, is a housewife, but you have her involved in real estate and get rep status or short-term rental. Just because by virtue of she's getting involved in real estate, you're saving $161,000. She's making $250,000 of W2 income. She's already making $200,000 by getting involved in real estate. She doesn't have to have a full-time job or even be a real estate agent. She can do flipping, she can do property management, she can manage her own properties. If you understand this, the people change career based on this advice. But let's move on to the next question. After buying 9 doors only, I'm struggling with 25% down payment. How do you handle? You just go to
Yeah.
DSCR loans, right?
Yeah,
Asset-based lending.
Yeah, actually, this is the exact thing that I'm facing this year. So I'm tapped out on my DTI. I have a lot of debt on my personal name. We bought everything under our personal name in terms of the debt. And my DTI is crushed right now. We are basically thinking that we are going to 1031 exchange some of our high equity properties, the ones that are very high equity but aren't producing that much cash flow, and kind of 1031ing them into buying more properties using the 1031. So we're basically buying more real estate without injecting any more cash, if that makes sense. As she said, you can also use a DSCR loan, which doesn't actually require you to provide any tax returns. Like they don't give you a loan based on how much income you make. It's based on how much income the property you're about to buy already produces. And so you can actually scale infinitely using DSCR loans. When people say I have 100 doors, it's not because they bought them using all conventional loans. They're using DSCR loans. Because maybe for the first 10 properties, you can do conventional, but once you get to that 10 doors, it's usually not based on unit size, more based on how much real estate you own. For us, it was about that $5 million mark. Once we get to that point, where no bank is going to give you money, right? Because you guys have a lot of debt already. So the next step from there is DSCR. So that's kind of where we're getting to right now.
And there's this new product out there. I have this lender I work with all the time and like personally, and they have this new product out there. I think it was very prevalent in Australia and I think they're bringing it in the US. Doesn't matter what your DTI is. They don't even ask for your W2 to qualify you anymore. All they need is bank statement. If you have enough cash in bank statement, you get the same amount of loan. So if you have someone who is hoarding of cash because of the market and everything, but your DTI is all screwed, let's say you have a $500,000 in your bank account, they just need that bank account and they'll give you $500,000 loan based on just the balance. I can connect you with that lender. You can talk to that lender. Just email us, whatever Kinsley has shared, and I'll just connect you with the lender, okay?
Wait, sorry, can you say that again? Can you explain? I didn't quite catch it.
So let's say you have $1 million in a bank account, they'll give you $1 million in loan without even asking for W2, without verifying your income, nothing else.
Okay.
It's strictly a bank balance based asset. It's very newer, and this lender is giving this loan out left and right. I will connect you with that lender. It's basically asset-backed loan. Rich people do that,
Yeah.
okay? But
I think I have heard of
this.
this recently. You can do it not just with cash, you can do it with your stock portfolio.
Yeah.
So let's say you have $500,000 in stocks that you don't want to sell. You can hand over your portfolio to the bank. You don't have control of it. And then you're basically giving up control of it without selling them. In exchange, they will give you a loan. Basically, they're using your portfolio as collateral. They give you a loan. And then eventually, when you build up enough equity in the property, they can use the equity in your property as collateral and they will give you back control of your stocks. It's a really good way to buy properties if you are sitting on a big stock portfolio that you don't want to sell in order to buy the real estate. Because if you sell, you're going to have to pay taxes. I've actually been thinking about doing that as well. Yeah, so pretty cool.
So remember, that's what the Bezos, Elon Musk does. That's what they pay zero taxes. They go deposit 1,000 shares of Amazon in the bank and then get a loan, which is never taxable, and use that money to buy go yachts and stuff. They're living their life by taking a loan, paying 0% taxes. For us,
Makes
we're
sense.
taking loan to invest in real estate. So next question is, should I max out HELOC and buy one big unit apartment or buy small unit properties? See, that's the investment strategy from tax standpoint. The more unit you have, more properties you have, more cost segregation you could get because every unit has different furnitures and appliances and stuff. I'm strictly talking from tax perspective. From investment perspective, more property, more diversification. I'm not gonna lie, okay? But you have to make that decision. But investment diversification, tax, more property, better. I'll let Mike answer if he has any comment on that one.
Yeah, more headache too, right? More units is not always more better, right? I think that's like the bigger pockets strategy is like I have 10 units, but what's your combined portfolio value? $800,000, right? They have 8 properties, but they're really cheap properties. Like nobody cares about how many units you have, it's how much net income do you produce. Nobody cares about unit size. If you can do better net income with less units, that is always going to be better. There's less headaches, less roofs to fix. Why would you want more tenants and make less money? It doesn't make sense. So anyways, that's me because I have 5 at this point and I'm not gonna lie, self-managing it, it's not the easiest. I wouldn't say it's hard, but it's not easy either.
And to add to that point, based on my experience, you driving down to talk to a property manager of 250 unit apartment is the same time talking to him versus going to 30 different apartments and talking to 30 different property managers. Remember, one big property can really give you less headache.
Basically, we're trying to consolidate now. We have a lot of equity in one property. We're basically thinking that we'll sell one, buy a multifamily property maybe, and then put a property manager on there right now. But right now, because we only hold single family, it's pretty easy to manage. But eventually when we do scale to that point, we will put property managers in place.
Perfect. There's another
There's a
one
lot of
is
questions here,
asking-
Shisha. Do you think we can get through all these? We only got like 5 more minutes here, right?
We have 5 more minutes. Maybe we'll make a video and send out all this video to all these attendees and answer this question. And then one thing I do want to offer them is our email address is shared there. If you can ask question, I will answer them personally. We're talking about hundreds of questions here. We obviously cannot go through all of them. Is there anything else we need to talk about, Kinsley, before we wrap this up? And then we can answer questions later on.
You all did a great job. I think you covered everything that we had on the list. We might have to have Mike back though. He was a huge hit.
Everyone loves Mike,
Yeah.
and we love Mike too. We'll do this again, and I'll answer all these questions for everyone through email and through videos in the next couple of days. Remember, Mike is always there to answer your questions. I'm here to answer your questions. You can always reach out. We are one CPA firm which do not hold back information. We'll give you information. You don't have to work with us. Just ask questions, we'll answer them. We are very good about that. And then if you want to work with us, you got our contact information there. You can schedule a free call. Same thing with Mike, obviously has his own community. But I can answer some of the question in the next few minutes too.
No, I think the only thing we missed was maybe like the entity structuring. They always bring up LLCs. I think if you're just starting, you really don't need to know that much about LLCs, to be honest. I own all my properties under my personal name. I have an umbrella policy. I will say though that I'm starting to convert them over to LLCs because we're basically using a new strategy called co-living. So we're turning a single family home, or basically we bought a duplex in Texas that has 3 bedrooms on each side, so 6 bedrooms. But we're planning on adding an extra bedroom on each side. So we'll have 8 bedrooms. We're going to be renting by the room. So we're going to have 8 different tenants. With that amount of people in one house, I do want to have a little bit more liability protection. For that home, we are going to be putting in an LLC. But for the single family homes, I have a single family home. It's a 3 bedroom and there's one guy living there. So for those type of homes, is it worth having an LLC that costs $800 per month or per year in California? Maybe not. They'll just get an umbrella policy. But for the most part, people ask way too many questions about LLCs. It's a really minor detail. She's actually helped me with the whole entity structuring thing too, understanding it. It's a rabbit hole. If you guys are going down this rabbit hole, you guys really don't need to be doing that.
Very simple answer is this. You don't need LLC to save taxes we talk about today. That's the only thing you need to understand from tax saving standpoint. From legal standpoint and compliance standpoint, I want you to understand something. Yes, you do want eventually, like Mike is doing right now, as you manage your risk, you do want to have an entity structuring which minimizes your risk. We will give you the structure. You can take that to your attorney and they will create one for you. I'm showing this on my screen. We're talking about holding companies and trust, how it affects you, partnership with other people versus your S corporations. If you have a fund, we walk you through all of this. It is complicated. This is not enough for this. What you need to take away is LLC stopping you from saving taxes right now? No, it's not. Go and buy property in your name, same tax savings as having an LLC.
Basically has no impact on your taxes. But I will say the one thing that you taught me that does save me the most amount of money in taxes is the S Corp. So if you have a business, like a side hustle or any other business that net profits more than like $50,000 a year or so, learn about S Corps. It'll save you tens of thousands of dollars in taxes. But the LLC itself will not.
What Mike is saying, real estate, never save taxes. Everything is green. No tax fine. S corp, when you have non-passive income like 1099 gigs, you have Amazon store, you drive Uber.
Like my wife is a real estate agent, so she net
Exactly.
profits over $50,000 a year, so she has an S corp right now. But before then,
That's
we were
what
paying, I think, more than $50,000 in self-employment taxes. So you saved us a lot of taxes on that, right?
Absolutely.
So I just want to say that's the thing about Ashish, about tax planning in general. If you have a good tax planner, they will always save you more money than it costs to hire them. That has been so true for us. Even though we pay Ashish every year, it's like it's the best money we can spend because he literally saves us more money than if you were to work by yourself using TurboTax. So it's literally the best investment you can make. It's more than 100% return on investment. So if you're working with the right tax strategist, they should be saving you more money than it costs to hire them. So it's a really no-brainer there. And you don't have to file your own taxes on TurboTax anymore. They can do the headache for you. So good benefit.
I'll tell people we're selling like $100 bill for $10.
Yeah, it really is.
Follow our social media. We're launching this. Everything you saw on our screen, we're converting that to a software. You can do your own tax planning. We'll release them, but you need to be connected with us to know when it's coming out. Connect with us on social media. We have given you all the links. You can do your own tax planning by the end of the year, and it's going to be amazing. That's why we are here. Just reach out to us, and we'll help you out.
Maybe you should share the QR code so they can just scan it real quick.
I'm going to share both screens real quick. You can take a picture. You can scan the QR code.
You don't have to show mine. My community is not set up if you guys want to join. It's going to take a while. So you can follow me and invest like Mike. But otherwise, I got nothing for you guys to join right now. One other thing I wanted to share with you guys before you guys leave. Regarding Ashish, the reason why I like working with Ashish is because when you work with a CPA, I worked with 4 different CPAs before Ashish. The number one thing I think it should be a huge factor in why you work with a CPA is how organized they are and what's your interaction with the CPA going to be like. Because I will give you guys an example. My very first CPA, they took payment over the phone. I had to call them to make my payments, which is absolutely insane in this day and age, right? And then number 2, especially for a CPA, like how you can take payments over the phone. When they send emails, how fast do they reply? And how good of a reply are they sending? Ashish, when you schedule a tax strategy, you can book a call, 15 minutes. Anytime you have any questions about tax strategy, you don't have to do emails. You can book a call and talk to somebody, and you can get so much more information in a 15-minute call than like an email thread. You can learn so much faster. And so that's actually how I learned about most of these tax savings. I just booked a ton of calls with Ashish and his team. And every time I had a tax planning session, I would list out 15 questions that I had about taxes, and I'll hit them with 15 questions in 15 minutes, and I'll just learn every single thing. S corps, LLCs. You're really paying for knowledge at this point. I don't know if I should say this, Ashish, but I don't pay for the tax strategy this year because I've already learned so much in the first 2 years. I paid for it for the first 2 years. I don't know if most of your clients do that, but I learned so much in the first 2 years. We're just repeating the same strategy. So this year I was like, do I really need a new strategy? Do I need to pay for tax strategy? I'm just doing the same thing that I learned in the first 2 years. So I don't really need it. I pay for the tax filing now though.
Exactly. And the good thing, what Mike is saying is true. Let's say we charge people $10,000 for tax planning that you use for next 20 years. So you're paying $500 a year for tax planning. Insane bargain. Second thing is you don't have to pay this every year. The first 2 years, you walk you through all this complicated stuff. And the good news is when tax planning software comes out, you learn this strategy, do this on your own going forward. It's going to be amazing. If you work with a CPA, pay for tax planning, do tax planning the first year, maybe 1 or 2 years, and then you'll have your own resource from our software to do this on your own anyway. It's going to be amazing. We'll help you guys out. I got to drop. Thank you everyone so much for your time. Email us, use the QR code, website investorfriendlycpa.com. So easy. Let's get connected. Have a great rest of the day, and we'll talk again.
Cool. Thank you.